along with Jordan, we'll go in through the details on the quarterly production and exploration. And then Jerry's going to give us an update on the financials. So I'll hand it over to you, Glenn.
Thank you, Mark. Good morning, everyone. Great to see so many familiar names joining us today. Just like to make a special welcome to Jerry. Jerry's joined us as CFO in Calgary. Has been doing a great job for the last few months. So Jerry, thank you and welcome to the team. Much appreciated. Mark and I are in Perth, and Jordan obviously is in Calgary. The quarter's been a very productive and profitable quarter for us, as you probably saw from our results. Production was just over 382,000 barrels for the quarter, and it resulted in earnings of approximately 12.5 million dollars Aussie for the quarter. Obviously, a bit of fluidity in the oil price during the quarter, and also the WCS differential has moved around, which resulted in a lower revenue base, but also resulted in lower hedging losses for us. One thing which we're very proud of, we made our first capital return / distribution of dividends to shareholders, and I hope you've all received your checks or direct deposits in the bank. If you haven't, please come back to us and we'll work through the share registry system. It may be because some of you hold stock in nominee accounts or in other structures that just take a little bit of a delay. One thing we have done at the moment is, while we were undergoing the capital return, we suspended our share buyback. The board is still considering what to do there. It was clear to us that a buyback needs to be material and significant to make a difference. We weren't committed to actually buying back a total of 10 or 15% of the stock. So we have to decide really what number is appropriate for us before we reinstate that program. But it is on the agenda at board meetings, and we will keep you abreast as we go forward. I think the other thing that's important to note, and will be run through today, is we're refocusing our attention on the Montney. We believe that the Montney is really a hidden jewel. We've always believed this. We've just not received offers or transactions that we were happy with in the past. And we are reviewing how we can de-risk the project to a degree by answering some of the questions that many of the counterparties who are interested in the project have asked us. And I think you'll see over the coming months, we'll be announcing strategies and ways forward to create real value from that asset. But with all that said, I would just like to hand over to Jordan and let him run through the operational results for the quarter.
Thank you, Glenn. Hello, everybody. So as you saw with the release of our quarterly report, over the last 12 months, and that's meaning October to October, so until present, we've grown our production significantly. Last October, we were producing about 2,900 BOEs per day of production. And now here in October of 2022, 1 year later, we've got our production up to over 4,000 BOEs per day. So that's about a 40% increase year over year. That's a result of the drilling that we did over the last 12 months. And what that drilling did for us was it helped replace the natural declines from all of the wells we had drilled in the previous year, as well as the natural decline of what we call our base production. And then over and above that, it grew the production by an incremental 40%. So a very significant production growth profile. This graph here you see in front of you is just meant to illustrate in 2022 what the different layers of production look like. So you can see the represented in blue is our base production. So that's all of the wells and production prior to the Leo, Pisces, and Gemini programs. And then each of those particular programs are layered in. And it just shows the impact of each of those different types of programs in Brooks and Thorsby. And should be noted that we've had a couple of Gemini programs this year in 2022, as well as Pisces. So you can see the wells come on, there's some decline, and we drill more wells later in the year. And it's each of those layers that got us to the current production of just over 4,000. We are in the middle of a capital program right now as we speak. So we're drilling wells in the Brooks area. So it's a 4.5 net, 5 gross well program. It's a combination of we have a Gemini program that consists of drilling our Sunburst formation in the Brooks area, as well as followed by that, there'll be a 2-well Pisces program, which is the Glauconitic formation. So you can see outlined in this table, it shows we're in the process of drilling Gemini 10, 11, and 12 right now as we speak. The drilling rig is in fact on Gemini number 12, and as soon as that well is finished, Pisces number 6 and 7 will be drilled subsequent to that. The estimated on production dates for those wells, Gemini, of course, in the Sunburst Formation does not require fracture stimulation. So those wells come on production a lot quicker. Usually within about 30 days of finished drilling, we get those wells on production. And then the Pisces wells, after they are drilled, they'll be subsequently fracture stimulated. And we anticipate those wells coming on production for the first quarter of 2023. So our average production for the fourth quarter is projected to be a combination of our existing base production and the Gemini wells coming on closer to the end of the year, but contributing in late November and through December. And the Pisces wells, Pisces 6 and 7, will come on in Q1 of next year. A lot of these wells are going into our 2 of 29 oil battery, and some of them are utilizing that the new pipeline that we installed earlier this year that connects our 2 of 29 and 15 of 23 batteries. Also, just a brief update on our waterflood expansion, the J2J pool. We speak about this from time to time. We're seeing some very positive results in the J2J pool as a function of that water flood. We are proven that we are repressurizing that pool, and production declines have not only flattened out, but production is actually inclining in that pool. So it's behaving exactly as we had expected, exactly has been modeled, and there are some future capital programs to take that water flood pool to the next level in the subsequent year.
If you want to continue with the Montney there, that'd be great.
Sure. As Glenn referred to, we're focusing a little bit more on the Montney as we draw ever closer to the completion of the LNG Canada mega project, which is slated to have first shipments as early as 2025. And according to LNG Canada, they are almost at 75% completion of that project. We know we're sitting on a very large resource in the Montney. It can be very impactful for us. So we are currently considering and modeling for a modest program in the winter season, Q4 and Q1 up in Northeast BC. If you recall, the original 2 wells that Calima drilled in 2019 had truncated production tests due to the upcoming spring thaw. So we feel that it will be very beneficial for not only Calima and its investment decisions, but for the potential for us to draw in a partner to JV with us on this project to retest those wells, both the upper Montney and the middle Montney. So we are modeling and budgeting for a potential program there this winter that will retest the upper Montney and retest the middle Montney to give us more certainty in the production capability rates of each of those 2 formations within the Montney. We think that with a little bit more de-risking via that the testing program, we can put ourselves in a position to make some further and more impactful investment decisions alongside with a partner through the next couple of years. And there's the potential to take that field to greater than 20,000 BOEs per day with significant capital applied to it in approximately 2025, which will coincide very nicely with the anticipated LNG Canada on stream date.
We've just included some recent economic updates from the BCOGC in relation to total production that's coming out of the Montney at the moment. As you can see, there's currently almost 10,000 wells on production. Importantly, production levels are around about 9 BCFE per day. So the expectation is that LNG Canada will utilize around about 2.5 BCF a day in its when it's fully extended, which is, a third of current production. And our expectation is that the economics of the AECO gas price will adjust accordingly once you take out 1/3 of that production, and it's not going down into the US. Additionally, we've seen almost, there was 1,230 wells drilled in 2021, 2022. So that's the drilling up in the Montney is back up to COVID levels. What we're going to do is we'll just jump across to Jerry, and Jerry's going to run through the financials. Just before we get started, Jerry, we've got a query here as to why our quarterlies are out later in the month, and if you could just give a bit of an update as to when we actually receive payments on our production and why we provide our quarterly at the end of the month.
Yeah, for a Canadian perspective, we usually receive our production 25 days after the month is closed. So, giving September revenue, we would not receive until October 25th. So, typically we would close a little after, maybe 10 days after the month ends. And then we would, start getting our accruals and everything else into our financial statements, and hopefully having everything to Mark and Glenn and Jordan and everything internally to review, and shareholders to review and to take a look at, a month after close, so 30 days after the month is over. So it's pretty standard here. I don't think you could get any faster. It's a balance between accuracy and speed.
Yeah, and ultimately, if we came in earlier, we would have to put in some estimates and things, which
Exactly.
is not something. Yeah, very good. Okay.
George, sorry, Mark. I think Jerry, this is standard for the whole industry that relates to the 25th of the month. It's sort of like the reconciliation day for all players in the oil and gas sector, isn't it?
That's correct.
Yes. Yeah. Okay. So it's not a one-off for us. It's
no, it's not one-off.
Industry has this. No. Thank you.
Great. All right, I'll leave it to you, Jerry.
Yeah, I'll just thanks, Mark. I'll just briefly go over the third quarter results right now. So, Jordan and Glenn had touched a bit on this, but I'll go through it. Like I said, our sales volumes were 4,162 BOE per day for Q3. So that's a 8% increase from the second quarter and a 40% increase year over year. Revenue was 30.1 million during the quarter. That's a slight decrease from the second quarter, but that was driven solely from a decrease in commodity prices. The world oil market and Canadian AECO price softened in the third quarter as compared to the second quarter, but we've seen a bit of a bounce back in October in the WTI price versus September, and we would expect that the Canadian AECO price would strengthen as we head into the Canadian winter here. So, just as a side note, at Calima, we generally receive WCS plus a slight premium on our oil, and that's just really due to the quality of our oil. So after costs such as royalties, operating costs, G&A, interest, and abandonment, we were able to show earnings before taxes, depletion, and accretion of $15.2 million for the quarter. And as I mentioned before, with Q3, we showed a bit of a softening in commodity prices, which affected our revenue, but it also helped us in terms of our realized hedging losses. We were able to decrease our realized hedging losses from $8.5 million in Q2 2022 to $2.7 million in the third quarter. And when we take those hedging losses into account, our cash flow from operations was $12.5 million for the quarter. As far as the capital expenditures go, they're $6.7 million, and they really consisted primarily of the drilling, completion, and equipping of the Pisces 5 well, as well as the completion and equipping of the Pisces 4 and Gemini 8 and 9 wells. That left us with a third quarter free cash flow of $5.8 million, which was a 61% increase from the second quarter, and $8.5 million free cash flow if we add back hedging losses. At the quarter end, we had $9.9 million approximately in the bank, no amounts drawn against our credit facility, and a working capital deficit of only $1.6 million. So, I think for me, the takeaway from the third quarter financially is, we've been able to continue to grow production in the company while maintaining a really strong balance sheet. So, we've put in our projected Q4 2002 numbers in the presentation. And I just want to point out, as Jordan said, the majority of the production that we'll get from the Q4 drilling program in Brooks won't really show up in Q4. It'll show up in the first quarter of 2023, and that's just a result of when the wells come onto production. So I think that's the run through of our Q3 financial results. Quite happy with them, and I'll turn the presentation back to Mark and Jordan from here.
Sherry. So just quickly in relation to the hedge position, as we keep banging on, we had a significant hedge loss for the 2022 calendar year. Those hedges all come to an end at the end of 31 December. These are the balance of the hedges that we have out for Q4. We're not anticipating much of a hedge loss during Q4 at the current prices in comparison to the rest of the calendar year. But moving forward, we will put in place additional hedging in respect of our put collar policy. It'll be something similar to what we managed to secure during the December quarter on the 250 barrels as set out on the screen. But we will, it'll be based on what the market's going to deliver. But it does give us access to upside and protects us on the downside. As we've I think the rest of the quarterly information is fairly well set out, and you can, if you've got any questions on it, please put it on the screen. So I think what we'll do now is we'll move to some of these questions. So the first question we've got here is, sounds like you have a preference to JV the development of the Montney rather than sell. Is this correct? I might just respond to that. We obviously, as an outright sale, we have an undeveloped asset. We're going to get a lower price for it. We've got an asset in the far northeast of northwest of British Columbia. So whilst we believe there's a significant upside, and we can see the upside in the assets return on investment if we put the money in, a partner coming in would have to take it as an undeveloped asset and would have to spend quite considerable funds in developing it, and they'll get all the upside. So they're not going to give us a significant payout on an outright sale. So we feel it's better at this time just to keep our options open. We want to be involved in the development of the asset, and we feel that that would give significant upside to shareholders. Next question. When, how, and where is the quality of oil assessed? From Stephen Matthews. Stephen, I might hand over to Jerry. Jerry can run through some of the types of commodity of oil that we sell and what pricing we receive for those.
Yeah, typically we're a medium grade oil, so we receive a WCS price. We do have a marketing department here, and we look at different pricing points for our oil, and we can blend our oil to get a better quality oil. So if a WCS differential blows out, I guess, we can truck our oil to points where we're not getting WCS, we're getting WTI. Now there's adjustments for that for the trucking, and there's adjustments for that in terms of the quality of the oil. But we do look at it every month, and we do have a marketing department here that tries to get the best price for our oil in different pricing points throughout Alberta. But again, we take into account there, Mark, how much it costs us to truck it, and what the quality differential is. And it is something that we do look at, like I said, every month. So it's not simply a matter of us just throwing our oil out to one particular point and taking whatever price we can get. It is done monthly for us to try to get the best type of return or net back that we can.
Yep. We've got a question here from Bill Murray. Why no hedging for 2023? Price can go either way. Bill, that's as I just mentioned, we will be undertaking additional hedging for 2023. So we'll advise the market once we have those hedges in place. Next question is anonymous. How do you choose between reinvesting cash and growing production versus buybacks versus dividends? It's a very difficult exercise to undertake that, but right now the company is focused on its production base, maintaining that base and adding to that base. At the same time, we're looking to provide a return to shareholders as opposed to necessarily on the buyback front. Our view is we'd rather provide additional funds back to shareholders through dividends as opposed to buying people out through the market, particularly as we won't have a material impact on the number of shares on issue. So the 2.5 million paid in October was not reflected in projected cash flow numbers for the fourth quarter. Bill, I think we did put the 2.5. It's down the bottom here. So you've got 2.8 sitting there, which is the impact of the buyback. Okay, next question from Daniel Pashar. The report shows the full-year capital expenditure 46. That's just a slight typo there. The 46 that was set out, it actually totals up to I think it's 42. So there's an error there. Granted, some of the oil was for the facility and pipelines, and not all the non-metal spend in the last quarter will be reflected in 2022. So this is in respect of capital expenditure and why we have a high amount of capital expenditure for the current year. As we've set out in the forecast notes below item 3, we believe that maintaining our production will cost us between 25 to 35 million per annum, and we're comfortable with that estimate moving forward. Okay, next question from Duncan Worthington. When do you expect to give guidance about 2023 and 2023 to through to 2025 production? Is 6,000 BOE per day still likely for 2023 as per your recent preso? I'll hand that one over to Jordan. Thanks.
Yeah, Duncan, we're working through the budgeting process right now as we speak, and we expect in the coming weeks to have something for the market. We will be drilling wells before the spring breakup period, which occurs between Q1 and Q2 of 2023. But the number of wells in that period and then the number of wells in the periods after breakup in late Q2 and into Q3 for next year are still under discussion and pending board approval. So we'll have something for the market, but we will assuredly drill enough wells to keep our production flat. And then the amount of incremental wells that we can drill is based on our free cash flow, and at current oil prices and current production levels, we will have significant free cash flow in 2023. And then we'll decide how much of that money is to go back into the ground and what portion of that money may be provided for shareholder returns.
Thanks. From Michael, this is in respect of previous estimates. The company had projections of 5 to 5,000 BOE per day initially. He's asking why we didn't achieve this level of production. I'll hand that one to yourself, Jordan.
Yeah, in May of 2021, we had talked about the potential for us to be 5,500 by the end of this year. But since then, we've had a volatile oil price, albeit higher for a lot of the period. But we implemented our share buyback program and capital return program, and we have been putting ourselves in a position to maintain and hold production at and around the 4,000 barrel a day mark for the majority of this year. And as a result, we'll be generating free cash flow, which kind of relates back to the previous question. And then the decision can be made to, we can get to 5,500 BOEs per day, but it would require us to spend the majority of our free cash flow, put it all back into the ground and grow production. So it gets back to the budgeting question of how much of our free cash flow do we want to put back in the ground versus maintaining low to no debt and continued shareholder returns. So again, more on that decision to come with our budgeting process for 2023, which again is related to how much of our free cash flow is to go back into the ground.
Yep. We've got a lovely question or statement from Margaret Pole. I prefer to not get a dividend and spend this money on acquisitions in the Montney position. Thanks, Margaret. I feel the same way as you. Unfortunately, we have other larger shareholders that want to get a dividend. Additionally, when we are paying dividends, it's not as easy as just the company saying we're going to pay a dividend. We have to clearly set out with our auditors that we have the ability to pay dividends from the returns being generated from the assets. So it does say to new shareholders coming in that it is a real tangible company. We do deliver profits, we do deliver returns, and we can pay dividends. Sorry, that's not Margaret, it's Yarp Pole. Thanks, Yarp. We have an additional question from Stephen Matthews in respect to the Montney retesting. Jordan, do you want to give a bit more info? It's a bit early days, obviously, with our planning, but what it would likely cost for the retesting and over what period?
Yeah, the retesting, we're costing it out right now, but currently our estimates are between and I'm talking Canadian dollars, but $4 to $6 million type of project. It depends a lot on, when we go into these wells that were drilled in 2019, we have to do it in the winter season, build an ice road to get access to the site as it is winter access only. And then what we'll do is it's called, I won't get into too technical details, but it's called snubbing into the well because they are live wells with gas and there's a significant amount of pressure on the wellhead. So to be able to run the equipment into the well while it is under pressure, and then you start flowing the well and flaring off the gas to see what the peak rate is on the well with relation to both gas rates and condensate or liquids rates. And again, if you recall back to when the wells were drilled, it was a very truncated test on both the upper, in particular the upper Montney, where it was single-digit % of the load fluid that was recovered from the upper Montney. So we really don't know what the upper Montney is capable of. It looked excellent while drilling, but we never did it any justice during the test. And the middle Montney, we did get a decent test on it back at that time, but again, it just barely got into the double-digit % of load fluid from the frac recovered, which is right around the period where those wells start to get into their peak rates. So the tests were cut short back then because of the spring thaw. So we feel it's a good use of our capital today with the increase in gas prices that just make the wells more economic. Being ever closer to the LNG Canada project being done, having a handle on exactly what these wells are capable of is going to help us, and again, a partner in making investment decisions. But we're more motivated to do it now because of the robust gas prices that we're experiencing and our outlook on gas prices between now and the on-stream date of LNG Canada.
Great. We've just got a few general questions in relation to interest from larger groups within the Montney, like Tourmaline. So we have undertaken a concerted effort to enter into discussions with Tourmaline and some of the other major large producers within the Montney. The issue that we've got is groups like Tourmaline, CNRL, Petronas, they have significant production. They have large areas that have already got access to being able to produce, and they have considerable amounts of wells that they've already identified that they can drill. So acquiring our project is not a priority to them. Tourmaline's around $25 billion market cap. They've given us some offers which we just didn't see there being a rationale for us to accept them. They were way too low. So we've got, more specifically, we do have opportunity from smaller groups within the Montney, and in addition to that, you've got the LNG Canada groups. Whilst you have Shell and Petronas are the major shareholders, Kogas, Mitsubishi, and PNOC are some of the smaller holders and they don't have any production in the Montney. So there's a lot of opportunity for us from the smaller parties and those groups to take a position. All right. Would we benefit from listing on the Toronto Exchange from Vilco? Vilco, we believe that would be beneficial. Clearly, the Canadian exchange is valuing our company and, well, in comparison to companies very similar to us, significantly higher than what the ASX is valuing the company for. We feel that the ASX has a preference for high risk exploration. There's a lot of companies on the ASX that don't have any production, that have materially high market caps, that don't correlate to the same economic values that we feel are reasonable. So we are actively looking into an alternative listing. Jordan, would you mind be able to just give a quick update on, as for the last question, everyone, just a quick update on Leo number 4 and what we've gathered from the results of that and its production?
Yeah, Leo number 4, as we have always said, it would take quite a number of months for us to really evaluate what the well is capable of. It had a large sized frac pumped into it, as it is in places a 40-meter thick reservoir. So it's been on production for I think about 3 months now, and so we've been evaluating the rates, evaluating the cleanup period. It has been taking a long time to clean up, but based on some of the analogous wells from other parties that are drilling a similar type of rock, as this is a different type of depositional environment compared to our Thorsby main pool, where Leo number 1, 2, and 3 were drilled. So we're continuing to evaluate it, and there's some additional land that we're looking at that we're going to be considering in the very near future, so that there's some considerations about releases around the Leo number 4 and that well. So I would say in the next couple of months, we might be able to come to the market with some rates from that well. And if we are happy with those rates and what future potential, if any, there is for the North Thorsby or Holburn play. So nothing to release as of yet, but it is still to come.
And maybe just in general, Jordan, just give an update just on the drilling program as it sits at the moment.
Yeah, so we finished drilling Gemini number 10 and finished drilling Gemini number 11, and they're shut in now for after post drilling, so that the buildup and pressure test from the downhole gauges can be performed, and the on-lease tie-in for each of those wells, as they were drilled on existing leases where we already had a tie-in point. So they'll have very quick on-lease tie-in and equipping programs on them. We are currently drilling Gemini number 12, and it will follow, of course, 10. We expect number 10 to be on production later this week, actually. And then, of course, it will be producing back the load fluid from the well. There's no frac, so there's not a lot of load fluid. And we do expect to start seeing oil in the initial couple of weeks after a well comes on production. So expected to be on production this week for Gemini number 10. Probably about 10 days later for Gemini number 11, and the same for Gemini number 12. And then, as mentioned, we'll start drilling Pisces 6 and 7 right after Gemini 12, which is the well we're on right now. But then those wells will be awaiting their fracture stimulation, which will likely be in the first part of December, shut-in period after that, and then, of course, a longer equip and tie-in, and then the bringing them on production in the cleanup period post-fracture stimulation will occur in January.
Very good. All right. Well, thanks everyone for your attendance. And I just want to say we had a really good quarter, great production. The guys out in the field are doing a phenomenal job, and we're all really impressed with the progress we've had to date. And Jerry, thanks for joining us on your first quarterly presentation and joining the team.
Yeah, glad to be here. Thanks, Mark.
No worries. All right. Thanks everybody for your time and have a great day. Cheers.
Thanks all.